My name is Juanita Archuleta and I work on the NinjaTrader business development team. We do have a very special event for you today with Adam of the trading practice. It is important to understand that there are substantial risks in trading commodity futures contracts and Forex. You should carefully consider whether such trading is suitable for you and will depend on your specific circumstance and financial resources. It is possible to lose all funds deposited with your broker and could even incur losses beyond these amounts. Please inquire at the following link for a full copy or for additional information of the CFTC full risk disclosure. Also, please remember that these training webinars are not a solicitation nor a recommendation, but simply educational in nature. The presentation today is presented by NinjaTrader LLC, which is the technology company responsible for developing and supporting the NinjaTrader platform. Brokerage-related questions should be sent to the brokerage team, and I've included their phone number as well as a valid email address for you to reach out to them. We are very excited for this unique event in which Adam of the trading practice will showcase combining order flow tools to find trades which are truly unique and therefore uncrowded. Thanks again for your attendance, and without further ado, it is my pleasure to welcome to the NinjaTrader webinar room, Adam. Go ahead and take it away, Adam.
Thank you, Juanita. Good morning, good afternoon, and good evening, everybody. I'm not going to spend too much time on a big, long-winded intro. I think we should just get straight into it. If you're not familiar with the term uncrowded trades, it'll become apparent to you. So we're just going to get straight into this. All right, so first and foremost, Juanita did cover this. Of course, it's important to just be aware of the risks involved in trading. It is also a requirement that we cover this off. Now, the good thing is, of course, you've actually spent some time already looking at one of these previously, I'm sure. So we'll keep progressing. Just a little bit of background. You're welcome to read through the details in the slide. However, what's most relevant, the most important thing is, when I was trading at a proprietary trading firm, I traded 90-day bank bills, which as a proxy for the 10-year notes, and I was using spreads to manage the risk. And it was this experience of trading like across a multitude of products, plus being in an environment with numerous other traders, many who had significantly more experience than myself, which spawned an approach to trading that starts with always asking what other products are traders also trading or not trading. We're in an environment now, I'm sure you're all aware, that program trading, algorithmic trading plays an enormous role in the financial markets. Most of us here are independent traders, so what we do in the markets really doesn't have any impact on the movement. So from the institutional side, which is really what dictates movement in the markets, most of the trading is what we refer to as non-directional. So they're typically exposed to a number of different products. There's also a quote here from Dr. Brett Steenbarger. Now, most of you are probably familiar with his work, a couple of books. I'm not sure if everyone's aware, though, that he's actually a director of trader development at Tudor Investment Corporation, which of course is Paul Tudor Jones from Market Wizards. So he's someone who spends an enormous amount of time currently and has in the past working with the absolute cream of traders in the global, globally. And it's through his observations that, I'm just going to read this straight out. Think outside the box. I'm convinced, based on years of experience working with successful traders, that there is no edge in being consensus. If you're part of the herd looking at the same charts, regurgitating the same narratives, there is no way to achieve distinctive returns. So today, if exposure to some of the ideas I cover sparks fresh ideas for you to come up with uncrowded trades, then attending today is obviously going to be of enormous value to you and well worth it. All right, so get straight into it. Now, You should be able to see a chart on the screen, the title that says when larger traders are not in the market. If you have a look at, this is actually a new tool or new feature that is part of the NinjaTrader 8's order flow suite of tools. So you do need a license version of NinjaTrader to access this, but it's well worth it, and you'll see from some of the other things I'll show you as to why. So in this chart that we can see here, these pink lines that I drew in, they just represent a time which, for me, Melbourne-based, 11 a.m. was when there was some significant data out of China coming out. So the point of highlighting this is notice that the markets were already open for a significant amount of time prior to that, but big orders only came into the market post that data. So this is just one example, and you'll see this very, very frequently, where a lot of larger traders stay out of the markets until significant data events have passed. So how is this helpful? Well, if larger traders don't commit to trading until, after waiting for data events to pass, what do you think is likely to occur at those areas of interest that were established prior to that time? And what could be those areas of interest? So let's have a look at that. Right, so here's, I'm sure most of you are familiar with volume profile. Now, if I just, let's have a look at, let's get one of these drawing tools up. Right, so you should be able to see a red dot on the screen. So where I'm highlighting this red dot, so this is just after 11 a.m. as you can see on the time on the chart. Now this big area in the volume profile, which shows where most of the trading up until this time has been conducted, the majority of that was actually established prior to that data coming out. Now we know that a lot of traders understand that acceptance, agreed prices, and what the volume profile means, those types of things. So you would also appreciate that you've got traders coming into the market who are likely to get short around this area. And you can see all of these areas where traders have actually worked, where we can see some two-sided trading and evidence therefore that we've actually got short sellers coming in. So the point of highlighting this is we've got traders responding to an area that was established by traders who don't necessarily dictate the overall movement of the market. Secondly, I'm sure many of you are familiar with opening range indicators, those types of things, thinking about the first 30 minutes of trade. This goes back to some classic texts in technical analysis. But what if we looked at the opening range based on the trading that occurs prior to a significant data event? All right, so all I've done here is plotted this blue shaded area is the area prior, so all of the trading range from the highs to the lows prior to that significant data coming out. So these lows and these highs were established by less significant traders. So these are areas of interest when you come into the market, and you can see immediately here that traders who were looking at getting on a break from these lows got washed out. So this is just a couple of ideas. I'm going to take you through this. Staying with this theme, relates to those big orders that were in the market that came in post 11 a.m. Right, so this next slide is the outcome. Now, I just want to point out this is not about, hey, look at this trade in hindsight that worked. That's not what I wanted to highlight. I just want to show you now that you can see that's the opening range, and you can see how we had traders who went short on the breaks of the lows who got washed out and caught. We then had you can see that all of the two-sided trading around this high agreement area that was established prior to bigger participants coming into the market, and then those traders being washed out, which fueled this move to the upside. And then further, we take out the highs of the opening range. So this type of idea is just based on looking at ways in which other traders participate, and also what many traders won't be considering. So this is what I would refer to as an uncrowded trade, combining a few of those ideas. The other thing that I want to highlight here, which gets back to those significant orders, I'm actually going to go back to those if I can. All right, so they're up at, if you see the price of where they are, right, 72.49 and 72.51. Right, so there's the 72.49 and 72.51. If you understand how market makers operate, so I'm not talking about over-the-counter markets, like every exchange-listed product still has market makers in it. When you've got significant orders that sit in the market for a period of time, they will do the best they can to move markets up to those areas. And additionally, you can think of those as being goalposts, if you like, for testing how far the market can actually extend to. So there's combining a few different things to look at ways to conduct trading that the majority of traders aren't considering. So just going over that point again, this was the depth just prior to getting up to those orders. So you can see how they established post-significant data coming in, and the market moved up to take those out. Now the point that I'd make there is that they were in the market for a significant period of time, because this leads into something else. Now I can't really demonstrate the next point, so you'll need to bear with me without the ability to show real-time data. However, another great function of the market depth is seeing large orders that have been in the market for a very short period of time. So those of you who are aware of quote stuffing, and traders who like to read the DOM and scalp, rather than having to rely on your memory of the history of resting orders in the DOM, you can watch orders that are placed and using this historical depth map, you're able to see if they were just placed just recently, or if they've actually been resting there for a significant amount of time. So I'm not sure if everyone's familiar with quote stuffing, but I will go into detail. As a side, I'd recommend Googling Paul Rotter, who was known as the Flipper, who, if you put those two details in, his name but also his nickname, you'll be able to hear about how he had an incredibly successful career trading the Bunds market through quote stuffing, right? So putting in orders that attract attention of other traders. All right, so bear with me, I'll explain what that means. And it ties into some of these other points that I was mentioning. Now, just before we move away from this this idea of the significant highs and significant lows, there's actually another tool as well, and another form of information that we can look at, and this is called the footprint. So this chart here, we can see where price moved beneath these lows. So I'm sure you can appreciate, without thinking about or having the understanding of some of the things I mentioned before, that there's going to be plenty of traders who look to actually go short on a break of those lows. So this now takes me to what I refer to as buying and selling fuel. So the chart that we were just looking at, you can see that in the top right hand corner here. Right, so that's that break of the lows. Now what the chart doesn't show you is what I refer to as the net aggressive buying or selling. So this is the footprint. Also, this is part of that order suite of NinjaTrader. Obviously, it's available in other charting programs, and there's been add-ons for years for NinjaTrader 7 and 8 that show this, but it does make it simple if it's combined within the one tool. So each one of these columns represents the 100 tick bar. Right, so that's how I'm displaying it, and it's color coded, which makes it helpful. And it's depending on what your screen resolution is, you may not be able to see the numbers, but what you can determine from this is based on the color coding, the more intense that the selling is, so the higher number, the darker the shading there. Just to clarify, just in case you're not familiar with the term or haven't seen the footprint before, what we're seeing here is just what you can refer to as aggressive buying or aggressive selling. Of course, buyers can either join the bid and sit there and rest with all other traders, or they can lift the offer and pay what sellers are offering. And similarly, if you want to sell, but you're not fussed about having to act immediately, you're not under pressure because you're trying to minimize a loss, you can join obviously the offer. Or if you're trying to minimize a loss and you're urgently trying to exit, well then you're of course going to just what they refer to as hit the bid. So what we're seeing here is just what I refer to as the urgent or aggressive trading numbers. So I look at this visually, and I'm sure you can all come to exactly the same conclusion, that as we're moving into those lows, all the trading that's occurring, the aggressive trading, is all on the sell side. Now, if you think about the market as an auction, there's only ever X number of buyers and sellers trading at any specific moment in time. Right? So obviously, if you just took a snapshot, it's got a limit to how many buyers and sellers are actually participating. So if we suddenly have an enormous amount of selling take place, in that moment of time, all of the selling gets used up. And so all that's left is buying. All right, so can you see how I've combined this concept with large orders in the market, even understanding how traders react at high volume nodes, but looking at them in terms of whether or not they're valid or going to be respected based on who is currently trading in the market, or maybe who established them previously. And we also looked at some highs and lows that worked around based on, again, when traders were or in the market trading or weren't. All right, and so that's a number of different points, but you've probably heard the saying, all of your ducks in a row. So all of this is actually a trade that I just took from a live trading room, which you've probably seen from a couple of those slides, which I run every day. And this is exactly a trade that we were able to participate in. And I remember distinctly looking at, not knowing in advance whether the market was going to continue moving through that area, but we avoided getting short because all the selling fuel had used up. Then the market worked up to that area of that high volume node. And it's just, being aware of these things means that we're not predicting where price is going, we're just watching how participants are behaving. All right, so I was talking about those orders that were in the market for a significant period of time before. I said I'd come back to that. So if you see big orders in the market that have been sitting there, and let's say you're looking at the DOM, you're looking at the auction, let's use some more common terms. You're looking at all the bidders and you can see all these big buy orders in there. It creates the impression to many traders that it's demand. So if I want to trade like someone like Paul Rotter, who's referred to as the flipper, what in actual fact he would do, and here's a classic example of it. Here's an order in the market that you can see that really, when did it come into the market? Only once price came down to this area. Now, what's the direction of the market? The market's going down, isn't it? But you throw in a big order like this, and all of a sudden a lot of traders will lean on that thinking, oh, well, there's a heap of demand. That's going to actually influence price to the upside. Right, so now I've highlighted this in the chart as well, so you can see it. So you can see all of this buying that's taking place, and there's a lot of volume that's taken place there, and a lot of it is because of this order that's in the market. But this is where you don't need to rely on your memory when you can use something like the order depth window. You can see when these orders come in, and if you're aware of this concept and how traders entice traders to do one thing because they actually want it to do it, the market to go another way, then traders who are already short will pop this in to create the scenario of a whole lot of traders getting trapped, which then when they exit, because there's a whole group of them exiting all at once, think back to that idea of only so many traders in the market at any one particular time, that all of a sudden, when they all go to hit the exit button because they're all under pressure, it pushes price to the downside. Here's another way in which you can be aware of what traders are doing or not doing, and how you can find uncrowded trades. So everything I've spoken about so far is looking at the markets in ways that other traders aren't trading them, so that you can find those trades that work basically because the crowd gets caught out. Just want to show you something. This took me a little bit of time, admittedly, to work out what was going on, but it's just through screen time that you try to pick these things up. So I'm sure that if you are someone who looks at a DOM, you've seen the speed of the orders in the market, the bids and the offers just spinning around. The analogy that I use is that they remind me of like a poker machine. You know, when someone, you know, pulls the lever on the poker machine and you see everything, all of the symbols just spin around madly. That's typically the behavior of auto stacker algos. So why am I mentioning that? Well, what is really a DOM? What are all these prices? They're actually advertisements. They're just advertisements to get you to entice you to act. So a good way to actually filter out what is just advertisements from what's really happening in the market is if you keep an eye on the tick counter. Right, so I use tick charts, which is tick, just think of it as trade. So if I've got a 100 tick chart, it prints a bar every 100 trades. When you see what you'll often, a way to highlight or recognize when these auto stackers are in the market, and I'll get to why you want to know about it in a moment, is that you'll see that if you're watching the ticks remaining, you won't see terribly many trades actually going through. So you see all these numbers spinning around, and if you were just looking at that, you think, oh my God, the market's it's a frenzy. I need to obviously get in and do something. And you'll see the bid and the offer that, you know, move up and down, and in actual fact, there's hardly any business being traded at all. So why am I talking about this? Because to dominate the DOM like that, you have to have an absence of a lot of big participants. Otherwise, you know, if you've got big players in there with genuine big orders, these auto stackers aren't going to be out. They can, put their orders in and out, but it's not going to influence all of the orders that are already in the market. So when you see that happening, it's a warning sign that A, there's no volume in the market, so you're in a situation where you've just got these algos who are trying to get you to trade by enticing you to do, buying the, basically getting back to behaving aggressively, hitting the bid or lifting the offer, and then taking you out a couple of ticks higher or lower. The good thing about these algos is, so it's frustrating to have to sit to the sidelines when you first see them, but they need a flat market to operate. All right, so just bear with me here because you can't obviously see the market moving. But if the market's moving directionally, they can't manipulate the DOM like that. But what happens if they sit there and manipulate the market and then finally the market moves? Well, they're going to have to aggressively exit. So one of the things that they can't do is operate directionally. So when you get a directional move away from this behavior, it's generally quite aggressive. And what I mean by that is you'll get, a thrust that pops up a bit if it's, to the upside, a little bit of movement to the upside, pops down a bit, continues, not that sort of grinding move. It tends to be quite aggressive. So you can get a pretty decent risk to reward trade on the back of that. Here's something else that I have been able to identify. Now, this is not something that sets up on a daily basis. However, once you're aware of it, once you pick it up, it's easy to, once you see it, each time it does happen, you'll be able to pick it up very easily, and it'll assist you with being able to formulate some uncrowded trades. So what I'm referring to here is this is a daily, these are just, this is a 45-minute bar chart with the volume profile plotted for each 45 minutes. So what I'm talking about, reversion in fair pricing. So accepted or fair pricing are these high agreement areas. That's for each one of these 45-minute bars. It's this red, they're coloured to make it easier to see. These red bars are where most of the agreement has occurred. You can see the rate of appreciation here, and then you can see how the market aggressively increases as far as acceptance is concerned. So I'm not looking at where highs or lows or anything like that is of the price. The actual, where the range of the bars is actually irrelevant to me here. All I'm looking at is the increase or decrease in value. And once you see value suddenly move much more aggressively away from what the mean is, you'll often see it have to come back. So it's just what I've referred to as reversion in fair pricing. Now, with everything that I've talked about so far, and it's a lot of ideas which I'm going to go out on a limb and say that you haven't seen before, because most of what happens in the institutional trading firms, it's proprietary of nature. It's not broadcast anywhere because they want to find an edge. Just on that, actually, I was listening to someone from another prop firm, and so when I traded in a prop firm, we didn't trade the ES, right, which is a really popular product. We traded interest rate products. What retail traders trade those? No one does. I traded 90-day bank bills. What the hell are those? It's like an unknown to many independent traders. So people are attracted to markets that are saturated where everyone else is. So the other thing to consider as far as uncrowded trading is what's the market that you're trading? Is that where everyone else is positioned? And have you got therefore a lot of competition? So every chart that I've shown you today is actually on the Australian dollar, but specifically between the hours that overlap with the ASX, the Australian stock market. Now, why do I do that? Because that is the period where I can find these uncrowded trades. So it's something to give some thought to. I know I'm in front of markets every day that the playing field is more competitive once we move into the European market. I know traders who will trade the ES during the overnight session rather than during the day session for exactly that reason. So something to consider is, here is a bunch of ideas that I've presented that are not known, to the masses, but also they're trading in a market during a particular time when there's an absence of a lot of other traders too. And that's a way to find an edge. Now, with everything that I've covered so far, nothing in itself is actually a signal to hit a trade, is it? So what all these things do is create scenarios or hypotheses derived from, importantly, multiple signs of supporting evidence. So I try to get a lot of ducks in a row, if you like. But then it comes down to execution. And I know that there's people in the room today that were in the live trading room yesterday, and yeah, we had an overall profitable day, but it was a huge move to the upside that we didn't get to participate in because from an execution point of view, we couldn't act quickly enough. All right, so hypotheses are one thing, and that's where morning prep comes in, looking at the markets, going through all of these types of things, looking at where data's coming out, what does that, when data does come out, what potential opportunity does that present, because there's a whole lot of traders that will or won't be in the market. But then the execution part of it, the actual buying and selling, whether it's to enter or exit for a profit or take partial profits or scale up or add or just cut the trade, that's another skill set in itself which only can be developed with practical application. The reason why I mention that is I just don't think there's enough out there on, hey, yeah, come up with a, call it a trading plan if you want, these scenarios, but that's actually very separate to then the execution aspect of it. Execution, plans are one thing, execution's another, and it's, it's definitely a separate skill set. All right, here's another uncrowded idea. So I was talking before about how I trade primarily during when the ASX market trades. Now, why do I do that? So I'll just give you a bit of background. So if you understand, and I can appreciate that I only know this because of my exposure as a prop trader, that big institutions, I think we all accept that they're the ones that dominate the markets and create the moves, that they don't tend to trade directionally. So what I mean by that is they don't have like a core position, the ES, and buy it for it to go up. That's not actually what they're doing. How they mitigate their risk, and this comes down to quants and programming and all of these types of models, is that they'll have a number of different products within the one trade. So they look for pricing inefficiencies and things like that, which is a whole other topic that we're not going to bother going into detail because it doesn't impact us. But the understanding that that's how they trade is important, because when you're looking at a market, and this is an FX currency, the Aussie dollar, yet we don't trade it in the live trading room seriously until I know that all the traders have also likely got their fills in the other components of their trade, which is the ASX stock market. Now, this will be the same for whether you're trading the FTSE and it'll impact the London stock market, etc., etc. But knowing when they're likely to trade will help you. Here's an uncrowded trade. If you look at the close of the ASX, so into the close, you watch for a covering move in the Aussie dollar in the last sort of 40 to 25 minutes before the close. Right? So that's just one idea. Now that's applicable to my time frame, but I'm sure that you can think of some similar type ideas that suit the products you trade, and then go and have a look, test it out. So therefore, I'm interested in when traders are trading particular stock markets around the world. So back to this slide, I've got VWAP on here. And what I'm referring to here is, as I was saying, asking the question, who is trading and what other markets are they trading? So the chart that you can see is of the the Aussie dollar futures, but I've adjusted the VWAP to start its calculation based on when the ASX opens, and also then when the European market opens. All right, so here's the Aussie dollar, and you've got the Aussie ASX session, and here's the European. Now I do trade into the open of the European market, but I'm asleep when the US opens, so I don't bother restarting it again. All right, so a long-winded explanation, but here's the point. Can you see how, all right, I've got 2 standard deviations from VWAP, and I'm sure many of you have seen 3 deviations, 4 deviations, 5, whatever it might be. I haven't bothered plotting any more than 2 because look what happens in the European markets from when they open and the Aussie dollar FX here. See how price just does not get outside those 2 standard deviations. Sure, it can hug the second deviation, but it doesn't get outside of that. So if you're aware of this high probability behavior, how helpful do you think that is in your trading? How helpful is it to be able to locate and fade traders who are actually expecting a move to get out of those areas because they're not aware that this is what happens? Right? So there's an uncrowded idea. One of the things that's occurred in the market that I'm trading at the moment is that it's also impacting the Australian dollar during the ASX, and you can see it here. And this week in particular has been a real bugger for it, to be completely honest. You know, I'm having to try to make a note to myself to be more respectful of, pay more respect to the second deviation. And that's just the nature of trading. Markets keep changing. So hopefully there's something that you can visually see in place that you can actually take away and start using now. All right, here's a chart that's going to take a little bit of explanation. So I'm hoping that you can all bear with me here. All right, so getting back to the idea of thinking about who's trading the market at a particular period of time. The chart at the top is the Aussie dollar, but but for the entire session. So it includes basically it's almost 24 hours, right? So it's the whole period, Asian, European and US market. And the profile that you see, so the individual daily profiles and also the composite. So this composite profile is just the sum of all of the profiles, or if you like, all of the agreement and acceptance and non-agreement, etc. for the data that's on the screen. By contrast, down below is the Australian dollar futures, but just for the ASX session. So you come into the market in the morning when the ASX opens. Most traders are going to be looking at this. Right? So this is the end of the day, and you come into the market. I'll just put an arrow on it, might be a bit easier to see. All right, so you come into the market, this is where the open is after this this profile here. Now where's agreement? It's all down there, you can see that, I'm sure. So where are most traders, given that we open up here, thinking value is? To the downside. So can you see what actually happens in the Australian market? First we get that push into value. Makes sense, right? But remember I talked about what are traders trading in the market, who are they, etc. Well, these initial traders aren't the bigger traders. The bigger traders who trade during the period are going to value the market based on where they think the Aussie dollar's got valued. Now, where was it the previous day? It was up here. So initially what's happened is there is a whole bunch of traders coming in from this area wanting to go short to get back down to value. But this is actually a low agreement area the previous day in the ASX, and here's value here. Can you see how we got this big move up? All right, so that's a classic. And in fact, yesterday, and for those of you that were present, we did this yesterday on the Aussie dollar, the only difference being that we traded it to the downside. But as simple as that. And you'll notice, if you use the volume profile, you'll see how we came up to a transition area. Then the market sold off a little bit, understandably, but then, and so what did this do? Well, it spent a whole lot of time no longer going up, didn't it? So what happens when that occurs? A lot of traders initiate shorts, and that's the when they get on the wrong side, that's the fuel, once all the selling's dissipated, for the movement to the upside up to this high agreement area. All right, so just to highlight there, by knowing when traders, who's trading a market at that time and who's not, and I'm just using an equity market, this is what I include in my daily trade scenarios. You know, how value compares from one session to another, depending on which perspective you're looking at. If I look at the entire session, value's here. If I look at just the ASX, it's here. That represents an opportunity for me. Here's another one. I've written here on the chart, gaps which appear on common chart settings. So I'm sure all of us are familiar with gaps on charts closing. But have you ever stopped to think about gaps occurring that maybe you're not seeing? So this is actually a 25 tick chart. And here's a gap here that eventually gets closed. But the point being that if you were to show, if we were to display this chart on say 100 tick, 200 tick, 5 minute, other common chart settings, you won't see that gap. Now we know that gaps tend to close. So here's another way that you can find an edge in the markets that the majority aren't aware of. So how I use these gaps is I don't go, well, I'm just going to go short. If I'm looking for a strong directional continuation, then I'm unlikely to get set to hold a position if I'm trading post a gap. So I won't hold for a big move. I'll look more for a smaller type trade. So just think of the times where traders look for the bigger move, and it doesn't occur because the market then closes the gap and they get out at scratch or break even. Even worse, they possibly take a loss even though they've seen the market move their way. So that's a way to be able to vary targets, etc., based on something that occurs in the markets that not everyone's seen. Right, so this is a fact, as you know, there's a large failure rate in the industry. Now, I've worked on both sides. I've worked on the institutional side as a prop trader, but I also have been a traditional stockbroker, and I was doing that, in the early 2000s. And I've seen the numbers. So you often hear about 90% or 92 or whatever it is of traders fail, all that sort of stuff. I can just tell you that I've seen over a significant sample of data, so not 3 people I know, but it's like thousands of trading accounts over a period of years, what the numbers are like. So I don't know the actual exact percentage, but what I can tell you is that the failure rate is very high. Now I'm not saying that to discourage you or anything like that. It's just a reality. So what I do each day is trade, but I run a live trading room. Now, everything that I've shown you today is an example of the types of things, and there's plenty more of them that I utilize to trade. But what I do is I get to talk about it just like I have today, but it's in real time. So for me, the live trading room, I get to chat about trading, which I enjoy, and trade all day, but also it's like an ongoing masterclass. So it's to address that high failure rate, just creating an environment which is focusing on maximizing trader profitability. From a regulatory point of view, it's important to me that, I come from a background of having gone through the GFC and everything else, and, we just had a FX flash crash. So regulations side of it's an important aspect. So the room that I operate is AFSL licensed, so it has an Australian Financial Service Limited license. So that should put people's minds at ease, and like you're dealing with a regulated participant. Each day commences with daily prep, which goes through some of these ideas. So some of the prep sessions I do prior to even placing a trade can go for like 20 minutes, covering off the ideas that pretty much create the blueprint for the upcoming day. And then you see real-time trade opportunities, and as I was mentioning before, that includes the instruction on where to enter and how we can scale up and take partials, perhaps scale out. And what you've seen today is also a number of institutional type tools, volume profile, cumulative delta, which is not something I spoke a lot about today, the footprint, historic depth map, etc. Now sure, these tools are all available to retail traders, but this is the type of, finally, which is fantastic, but it's combining all of them to be able to present trade opportunities that takes into consideration a multitude of factors to be able to make a trade. And it's that combination of things that I think that is partly responsible for the success of the room. So if you've seen some things here today and you go, well, I don't even know if what he told me was, if it's genuine, maybe it's actually not effective at all. I'd invite you to sign up for a 3-day trial of the live room. Runs for 9 hours, sometimes longer each day, and you can actually participate and see this, importantly, in real time play out. And if that helps trading out, then that's a win. So you can just go to the site, thetradingpractice.com, and there's a green button there that it looks exactly like the one that you can see in front of you, and you can just sign up for a trial, and I'll make sure that you've got access to the room. And it'd be great to see people in there and being able to take some of these ideas on board and implement them into their own trading. That brings me to the end. So hopefully that was succinct enough for you all to gain some value, and that even if you don't come to the live trading room, I hope that you've seen some things that you can start working with and finding some trades which are not what the common masses are doing.